Tanvee is, the chief India Economist at UBS. It's great to have you with us, Tanvee. And of course, this is also, on your new report talking about, kind of how much more pain we might see and really what the way forward is looking like. So just to start off with, give us a sense of where you feel we're at with regards to the economic scenario. We were just talking to Saurabh and he still sees the recovery a while away. How bruised is the economy looking according to you?
We have something known as UBS India Financial Conditions Index, which is a good leading indicator, and we get the data on a monthly, daily basis because it basically looks at what's happening on the bond market, money market, credit market, currency market, equity market. So it basically compiles all the market information and gives you the lead indicator and how the trend will be going forward. So basically what it is suggesting, it actually kind of started easing from March of 2019 onwards. It tightened significantly in the months of September, October of 2018 during the NBFC crisis. And now, even though it had started easing and we were a little more sanguine that maybe the worst is behind us, for the first time in August of 2019, it again tightened. So basically our view is that the real GDP growth, which collapsed to 5% in the June quarter, likely will be the trough. We do expect recovery, but again the recovery will be elongated, well below market expectations. In fact, if you look at our full year GDP growth numbers, we are well below consensus. We are only at 5.9%. So I would say the recovery looks quite elongated and will be a very, very gradual U-shaped recovery versus, there were still hopes even a month back that there could be an L-shaped recovery in the second half. So that looks unlikely at this point in time.
If the capex cycle does not pick up, how dangerous that could be? Nobody's talking about it. Everyone is telling me, okay, recovery is around the corner, base effect would kick in, but that's all optical illusion, Tanvee. For any economy to do well, the investment cycle has to pick up, and investment cycle ain't going to pick up because entrepreneurs do not want to spend, banks do not want to lend. Those who have the willingness to expand don't have capital, and those who want to expand, banks are not giving them money.
I agree. So what is happening right now, because the consumption has slowed down so significantly, even though if you were seeing capacity utilization levels across few sectors picking up, and if you look at RBI aggregate capacity utilization levels, they are closer to 77% as of the last quarter. But looking at an uncertain demand situation, why would any corporate would like to put in money into capex till the time you're not sure whether the demand trend is on an upswing or it is going to remain muted for a longer time? So even if the view was that the capex recovery could be coming over the next 12 to 18 months, looking at the current growth slowdown, and I must remind that this is not only because of what we are seeing in India. Globally, we are worried about the global growth slowdown. We recently at UBS reduced our GDP growth forecast for the US economy by 50 basis point, 30 basis point for the China's real GDP growth. Because of the recent trade war escalation, we think that it's not only an India story. Globally, we think that the growth will remain below potential until middle of 2020. So in a scenario where even the global economy is not supportive, consumption domestically has slowed down very sharply, I don't see any immediate need for the corporates to start putting money in capex. But how do you then get the capex cycle revival? Obviously, we need to wait. It is not something which is going to come in anytime soon. But if you look at the overall capex spending, 40% is by the private corporate sector, which looks unlikely to revive in the recent growth slowdown momentum. The rest is public sector will account for 20% of the capex spending, and the balance, say 35 to 40% is by the households. If we do see any government push to revive public capex, government has been talking out a very ambitious spending on infrastructure over the next 5 years. If we do see front loading of that spending, obviously the question is where are the numbers to support that expenditure in terms of revenues. But if we do see support in public capex and there is some more boost provided, say for affordable housing, even at an aggregate state level, we might see some pickup in capex cycle, but that is more an FY 21-22 story. But private corporate capex as of now, the outlook looks quite muted at the moment.
Right. Tanvee, the question now one wonders is what is the MPC going to do? Because it's been a steep rate cut that they actually executed last time. The government is doing all the right things. We already know the kind of hefty dividend that the central bank is also going to hand out. What next? Do they continue to cut rates? Is that the expectation?
So, well, our view is that we do expect 25 to 50 basis point rate cut further. So, we are expecting the terminal repo rate at closer to 5%. That said, I think the incrementally, the problem is the monetary transmission in the economy still remains weak. So if I look at, say, a double B corporate bond spread or a triple B corporate bond spread and look at the spread versus, say, a 1 year T-bill, they continue to remain elevated despite RBI cutting interest rate by 110 basis point. Obviously, lower cost of borrowing helps in fastening the deleveraging process, but the thing is, how long can you continue? So I, at this point, think that aggressive monetary easing may not be able to revive growth. What is needed at this point is definitely some kind of fiscal support. Even though the government has been doing the right things, for example, they are front-loading their government spending. We did see the data for the month of July that the government spending was up 24% year on year. You look at the June quarter, the spending was up like 2% year on year. So they are fast-tracking GST refunds, they are fast-tracking the payments which were stuck in the system. So all those are the right moves. So I would say if the data continues to disappoint, I would expect some kind of fiscal support measures, which I think the government is already doing. The question is whether the revenue collections will surprise on the downside and could actually lead to more fiscal slippages. But at this point, 0.2 to 0.4% of GDP fiscal slippage is something which looks likely if the government wants to provide some kind of fiscal support measures to stimulate demand in the economy.
Okay, let's look at a realistic scenario here. And when I say realistic scenario, world is going to contract further, there would be a currency war, trade intensity or trade war is going to intensify further. What happens to us in that case situation? You know, we are focusing on GDP growth, we are focusing on consumption, we are looking at the capex, we are looking at high frequency data points like auto. But somehow there is nobody, at least me, I don't have a handle on global trade and how that will impact the real business and how will that impact India.
I think if you compare India and compare it with other emerging market economies, on the margin, India is in a better position because you're relatively closed. Our export share to GDP is only 23% or 22%, which is right now, even the outlook is not looking bright. In that sense, the direct impact on India is marginal, but obviously if the global economy itself is shrinking, for example, we are expecting 3.2 and 3% global GDP growth versus it was closer to 4% a year back. In that scenario, India is not immune. So what will happen is if the China's economy is slowing down and we do see an impact on other Asian economies, on the margin, other emerging markets are also using monetary and the fiscal space to stimulate the economy. In our case, our fiscal balance sheet is already quite stretched. That's why the onus so far has been more on monetary easing rather than fiscal easing. So how do we see going forward? I think on a margin, India will be relatively better off if the trade war escalates from here, which I think is, we keep on hearing every day one or the other news flow, but obviously we did see the trade war tariffs escalating from the month of September. We still have to see what happens next, whether there is some kind of reconciliation or the tariff keeps on going up as and when indicated. So I would say if you look at Indian currency, because if we are saying that RMB could depreciate or remain weak at 7.2 for this year, 7.3 for next year, I think, and there is pressure on other emerging market currencies, I think Indian rupee will be marginally be okay. So we are looking at the fair value of rupee at 70 to 72, looking at the productivity adjusted read basis. That said, we do see depreciation bias in INR. It could go to as low as 74 towards this year end, that is end FY20. And that call we have taken more on global factors because domestic growth slowdown seems already priced in, looking at the INR underperformance versus Asian peers, specifically since the month of August onwards. So we do see depreciation bias in INR, 74 for year end before it recovers back to 72 for next year, that is end of FY21. So near-term depreciation bias more because of global headwinds. I think the domestic growth slowdown is already priced in the currency move right now.
Right, Tanvee, great to have you on the show. Thank you so much for taking the time out and joining in today.